Fear me not, good people of Oz. Fear me not. For it is I, the great and powerful Wizard of Oz. Man, that scared me when I was a kid.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the Retirement Answer Man, Roger Whitney.
For the longest time in my career, I wanted to be the great and powerful wizard of investing. I think some of it was if I could figure it out, if I could learn the secret, I could wow my clients. I like to please people. So I went and studied with Wharton professors and learned how the big boys do it. I learned about portfolio construction, standard deviation, calculating standard deviation. I remember having to memorize that formula, calculating correlations and alpha and what these ratios meant, and doing due diligence on managers and analyzing portfolio attribution. I went and studied with some of the best in the business on advanced planning techniques, all with the idea of becoming the wizard. I wanted to be the one that awed people. As the wizard said, you have nothing to fear so long as you believe. When you believe, anything is possible. And I wanted them to believe in me as the wizard, that great and all-powerful wizard. The problem was I was focused on all of the wrong things. I thought it was all about portfolio management. Don't get me wrong. You got to do that right. But in our quest to do portfolio management right, we end up getting distracted ourselves. And I think most advisors end up getting distracted and not helping people create the kind of lives that they want. So we're in January here, and it's annual review season. I'm having annual reviews with clients, and I come with an agenda, and we're going over the items that, we go over every time. And I imagine if you do everything yourself, that you're doing your own annual review on your financial plan and your finances. And if you have an advisor, you're probably getting scheduled to go talk with them. And a typical financial advisor meeting goes like this. There's small talk. How's the family doing? How was Christmas? What'd you get? What are you going to do for 2018? Sometimes the small talk turns into big talk and can dominate the entire conversation. And then once you get down to the business, what I see all the time is the advisor reviewing, okay, we have you as a moderate investor, and this is your objective is growth with income. Is that still accurate? Does that reflect you? And you're like, yeah, sure it does. Okay, well, given your risk tolerance and your stated objectives, here's your portfolio. And then likely you'll be in a conference room where they'll put it up on the big screen, or they may have a flip book that shows you the portfolio. And then you'll dive into, okay, here's the pie chart, how you're allocated. Let's talk about alpha. Let's talk about standard deviation. Let's talk about which pieces did really well, which pieces didn't do really well. Now, let's talk about investment performance. Here's how we did relative to our benchmark. Here's why we underperformed. But don't worry, it's a short-term thing. Or here's why we outperformed. Then we'll get to the market outlook. And that's usually what people really get into, right? They'll get into, this is what our strategist says for the coming year, what are going to be winners and what are going to be losers. So as a result of this, we're thinking about adding this or subtracting that. And, well, you may have that strategist in town here in the next month or so. So we'll send you an invite. We'll bring you to dinner and you can hear the big presentation to talk about more geeky stuff. Great. Say hi to the kids. I look forward to seeing you in the first quarter. That's a typical advisor meeting. Nothing wrong with that if it's about portfolio management. A lot of times we're along for the ride when it comes to portfolio management because we get into such geeky things that don't mean anything to us. We just got to believe that they got it taken care of. Unless you're religious and believing in God, faith is not a strategy for creating a great life. What ends up happening is most of us, if we're managing our own assets, most advisors give lip service to the planning, and really what they want internally is to be portfolio managers, like I did. or asset gatherers. So we give lip service to the goals in the life planning so we can get the assets, or we can geek out on all the stuff we're really excited about. And as a result, none of this stuff that gets talked about answers the really important questions. When can I retire? What lifestyle can we have right now, not just in retirement? What lifestyle can we have safely in retirement when we're younger and healthier and more active? How do we manage cash flow in retirement? What should I do with this money sitting here that I got in a bonus or whatever? How do we actually do retirement and make that transition? Questions like, can we buy that new house? What about that boat? Can we gift more to our church or a charity? Can we travel more now? Can we travel more in retirement? I may have to help a family member. It sure would be nice to be able to spend more in retirement. It sure would be nice to save a little less right now. Can we do any of that and still be okay later on when we're 80 or 90? Questions like, are we going to be okay? What might we be missing? Most of the normal meetings I see and most of the evaluations people do themselves aren't focused on these questions. That's a problem. And I think we're going to talk about that here in the Hot Topic segment. But first, we have to have that all-important disclaimer. Now it's time for that all-important disclaimer. Of course it is. Now, first off, I want to disclaim, I'm not saying this about all advisors or about all people that manage their own assets. I'm just making observations of what I see all the time. There are amazing advisors out there that are helping people make important decisions to create a great life. I meet them all the time. And there are amazing individuals that manage all their own money that are doing exactly the same thing. So I don't want to paint too broad a brush on my opinions here, but I do think this is much more the norm, what I describe. Now, I am not your advisor. I only give advice to clients that I walk life with. Unless you are one of them, think of this podcast as helpful hints and education. And before you make any decisions, talk to people that do know you and what your main thing is. It could be your legal advisor, your financial advisor, or your tax advisor, because that's just common sense. Now let's go talk about some of the things that distract us from having more meaningful conversations. So the last few weeks, we've been doing this market correction fire drill. And this is a great time to do it when by the time this year, we may have already hit 25,000 on the Dow. And I want to add an addendum to it that I think is just as important. And that is, it relates to something Stephen Covey often said. He said, the main thing is to keep the main thing the main thing. And in our case, most likely, the main thing is to live a great life right now and have confidence that we have a process so we can have a great life later on and be a good steward of what we have. And oftentimes what I see by individuals managing their own assets, or because I live in this world, advisors, they try to be the Wizard of Oz and focus on investment management as the chassis. And many times they're not focusing on the main thing. They're focusing on the minutia that seems important, that big shiny head of just believe in me and I'll manage all this and it'll all be okay. That doesn't work, in my opinion. So here are the things that I see often that I think way overcomplicate the situation and distract us from the main thing, which is our life. So number one, what I see is over diversification. And this could be individually or an advisor, or a lot of times it's these overlay asset allocation programs that major firms offer. I saw one recently from Fidelity where they were, for an additional fee, they would build the asset allocation and rebalance and manage everything. And this client was onboarding, so I was reviewing what they had. And the thing had 20, 30, I've seen up to 50 mutual funds used to build out an asset allocation plan. It was a mess. It overcomplicates everything. In my opinion, it doesn't really add any value. And it distracts us and makes us start to get into conversations about all the technical stuff rather than the main thing. And it's, in my opinion, not adding any value to the situation. I mean, it gets confusing. It intimidates us which gives us less confidence, which makes us defer to the expert or the firm or whatever. So that's the first thing I see a lot, is just way too many positions, even mutual fund positions. The second thing I see are advisors acting and thinking they're portfolio managers, where they're building out accounts that they're managing with 50 to 100 plus positions of stocks and mutual funds and bonds and ETFs and everything else. And I understand that because I've done it in the past, because advisors tend to get into this business because we love finances. We love investing. We think of ourselves as investment people. Here's the problem with that, in my opinion. One is, it can be a god-awful mess when you look at an account. Two is, think of an advisor's role. An advisor, they got to manage their practice. They probably have staff. They have to market. They have to prospect. They have to meet clients. When do they have time to do all the research and the trading to actually be the portfolio manager? Now, I know portfolio managers that manage billions of dollars. I've met them, spent time with them. They're pretty serious people. They do one thing, and they have a staff of analysts and strategists that help them do that one thing. So I don't understand how that works, and it creates a lot more complication. And then the conversations with the advisor becomes all this technical stuff back to the flashing head of the great and powerful Wizard of Oz. So I think that's a big distraction. I see that a lot. The third thing I see are overuse of what are called separate managed accounts. So these are accounts where, rather than, say, buy a mutual fund to get large growth exposure, the advisor and the client use a separate account manager, which is basically a mutual fund just unwrapped. So the client actually owns all the different positions in the portfolio individually rather than just the packaged mutual fund. And the promise of this is typically, hey, you're going to get access to these institutional managers at low minimums. So that's going to add a lot of value to you. You're going to get to have this customized a little bit because we're going to own all the individual positions. And lastly, we'll be able to do some real active tax management because you own each individual position of the portfolio, not just simply the wrapper. So that's the promise. I've used them in the past. Here's what I see the reality is. One is access to great managers, easily gotten through mutual funds and ETFs. There's nothing that fancy out there outside of the hedge fund world that you can't get access to. So I don't think that cachet means much. Second, in reality, I don't see really any customization happening, and I have not through all the people that I've known, because, basically all you're doing is, usually these institutional managers are managing mutual funds, and it's just overlaying the portfolio, and it's all done through, technology. It just populates the trades for you. And then lastly, rarely do I see any meaningful tax management being done in terms of realization of losses and neutralizing capital gains and things like that. Now, I'm not saying that they don't have a place. They do, if you're wealthy enough to use them effectively. What I'm talking about is clients under $5 million in assets that have these. There's really not that much utility in creating all this complication. The side note of these separate managed accounts is it's a huge distraction because you get 100-page plus statements, much more difficult tax accounting. There's the mental accounting of seeing, hey, why did they buy this stock at 100 and sell it at 30? You get to armchair quarterback every single individual trade, and they just add lots and lots of complication. I mean, you open that statement, and it's over 100 pages. How are you supposed to even understand what you own? And all of these things, over diversification with, 10, 20, 30, 40, 50 different mutual funds, or these huge portfolios with all these different positions, or these separate account managers, all distract us from the main thing, which is the things that we have the most control over: managing our balance sheet, managing our cash flow, understanding what risk we're taking, all of that other stuff. And it, in my opinion, doesn't add any value to the overall situation. But what it is, this may be the worst thing, it is a big distraction in that now the conversations with the advisor, or the conversations you're having with yourself when you're analyzing all this stuff, gets focused on the little bits and pieces of this particular position, that particular position, this manager, performance attribution, all these other technical stuff that really don't make any difference in your life. What's a better solution? if you're going to manage risk and try to create a great life. I think one is to keep the main thing the main thing. Don't make it more complicated than it needs to be. And then next week, we had a great question from a listener where we're going to talk in terms of if you're using an advisor, what should you expect, and is it even worth the money? So we're going to get into that next week. But for now, let's go over to the practical planning segment, talk to Nicole, and actually answer some techie, geeky questions. Hey, Nicole, welcome to 2018.
We made it. We survived the holidays.
We survived the holidays and had a great time, and we are ready to take it to the next level in 2018, right?
Yes.
All right. So with that, we're going to start off the year with a bang with some very geeky questions.
Super geeky. I don't even know if I'm ready for this.
We're going to have an official geek hat or geek alert that we put on.
Like that. We need a sound effect.
Yes, we need a geeky sound effect. So we'll have to come up with one. But for now, geek, 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 geek. How's that for now? Okay, we'll work on it. Okay, so let's go to the first geeky question from who? John, it looks like.
Our first question is from John, and he was playing around with a portfolio visualizer tool and ran across some new terms that he did not know and wants to ask you, do you think that a higher Sortino ratio and or a higher Sharpe ratio of a portfolio would be a good measuring stick to decide if one portfolio would be better than another for long-term investing? So, Sharpe, Sortino, I don't know those guys.
They are, well, at least Sharpe. They are actually guys. William Sharpe created the Sharpe ratio. So, all right, John. Well, these are some geeky ratios that you're bringing up, the Sharpe and the Sortino ratio. We'll talk about what they are briefly. But to your question, which one is better? Which one should be higher when you're looking at a couple different portfolios? I always start with, what are we trying to solve for? If we're trying to build a portfolio to help you in retirement and create a life that you want, these are probably going to be, they're not going to be very meaningful for that purpose because they are focused on what investment consultants use when they're working with pensions and foundations to do portfolio analysis. Some of it is justifying their existence, to get really geeky. And some of it is that they are trying to tweak asset allocations with portfolios that have very different purposes than you, me, or someone trying to retire. So I don't think these are going to be that useful in helping you. And I think you can spend a lot of time focusing on these type of very minute ratios that really don't move the dial anywhere when there are so many other big opportunities for you to move the dial from an investment standpoint and from a planning standpoint when we're focused on retirement. So that I would say I wouldn't worry too much about these ratios. Find a portfolio that fits what you're trying to accomplish from a spending standpoint. Now, let's just define what these are. We got the Sharpe ratio. This is a risk-adjusted measure developed by Nobel laureate William Sharpe. So it uses standard deviation, which is the amount of variability of a portfolio, and it tries to identify the excess return that you receive from a particular manager, usually is where we would use this, over and above an index or its benchmark. So it's trying to use, okay, based on the standard deviation, how much extra return are we getting for the risk that we're taking in this particular strategy? So the higher the Sharpe ratio, in theory, the better the fund or the strategy's historical risk-adjusted performance. So it's a relative measure. Now, the Sortino ratio is a variation of the Sharpe ratio and basically takes the stance of, hey, we care about volatility, but really what we care about is harmful volatility, right? Volatility to the upside is good. It's trying to isolate the harmful volatility in a ratio that will give you an idea of, okay, how much bad volatility is in this particular strategy, which, relates to upside downside capture, which means upside capture is, when markets go up or a benchmark goes up, how much are you capturing of the upside? And then when markets go down, how much are you capturing on the downside? So something with a high Sortino ratio would basically say, wow, when markets go down, it's not capturing near as much as the downside. And the idea is to be able to isolate a strategy that gets out of the way during bad things, but is able to be in the game when things are going well. Now, analysts commonly prefer the Sharpe ratio to evaluate low volatility portfolios because, you're not worried about the downside volatility near as much. Whereas Sortino might be more helpful when you have something that's really volatile. That means they're probably really trading a lot. But at the end of the day, John, the breadth that I used to explain them is more time than is really needed on them because there are so many other more important things we can do to create a great retirement and to invest successfully. So I wouldn't spend too much time on these. All right, so let's dig ourselves out of the muck of Sortino and Sharpe ratio. I think I even got a little mealy-mouthed in there because it was so much technical stuff. And let's go to our next question, Nicole.
Well, we're still kind of in the geek hat arena, but
Let me get my hat. Let me get my hat back on.
Get your hat back on. This question is from Terry, and he wants to know, can you discuss the pros and cons of QLACs?
QLACs. So QLAC. That stands for Qualified Longevity Annuity Contract. And you will find, especially when it comes to insurance and estate planning, they love their acronyms. So what is a QLAC, or Qualified Longevity Annuity Contract? So this is an annuity contract, makes sense, where you defer payments and then they start and then those payments are guaranteed till death. Now there has been strategies around, well, what if I took some of my IRA, my individual retirement account, and invested in a QLAC that had these qualified payments starting in the future and somehow avoid having to take RMDs, or required minimum distributions. See what I'm talking about with the acronyms? So the idea is, if I have a $100,000 IRA and I put, say, $25,000 into a QLAC, that can help me, in theory, avoid having to take RMDs on the money that I put into the QLAC. There's been some guidance not that long ago about whether this is possible from the IRS. And this is the guidance that they've given us, is you can do that only if up to 25% of an IRA goes into a QLAC, but that cannot exceed $125,000. So even if you have a $2 million IRA, you can only do up to $125,000. The deferred payments from the QLAC, or that annuity contract, can't be delayed beyond age 85. And then lastly, that annuity contract, that QLAC, sort of fun saying now, cannot have some type of surrender provision, meaning that it has to be illiquid. It's an irrevocable contract. If you do all those things, then the money that you put into the QLAC will not be counted when you have to do your required minimum distributions. Now that we know what it is, you got that down, right, Nicole?
Maybe. Is it $125,000 total or just per year from the IRA?
My understanding is it's total.
Total. Okay.
Obviously, you're going to want to talk to your tax consultant if you were to pursue something like this. But now it comes to, does this make sense? So my short answer is generally no, it doesn't. Sure, you may delay some of the RMDs, but it's still going to force out money from the IRA at some point. And then you start to get into time value of money and opportunity costs. So we take this money, we put it into a QLAC. So when you put this money into the QLAC, it's irrevocable and you're just going to get those payments until you die. And I don't think there's a remainder beneficiary. So that money won't be there for the next person in line as a beneficiary. The other thing you have is, for the majority of the time, you're getting your own money back, right? Because with an annuity contract, if you put in, say, $125,000, well, you have to have enough payments to at least get your money back. And then only after you get $125,000 in payments back, do you actually start getting any kind of return on the money. Whereas if you did not do a QLAC and you did the RMDs and invested the money, the odds say you're likely to have a better long-term return. So I think for the vast, vast majority, this is really not a good deal. Now, if you want a more deep analysis of this, you can go to Michael Kitces' blog, Kitces. He is my super geek friend, and he did an analysis on this that was very helpful in me answering this question, but also would give you some really geeky details if you want to go even deeper. Okay, Nicole, can you do me a favor here?
Sure, what's that?
Can I take my geek hat off?
You can take your geek hat off. I think that's enough geekiness for one episode.
All right, what do we got?
So actually our last, it's not really a question, it's a comment.
It's easy. I like it.
Yes, I like that too. You've talked about on this show before how important it is to invest in your health. And David, who is a client and friend of the show, wrote in to say, as a very healthy eater and as a taxpayer who opposes corporate welfare for Big Ag, I wanted to point out that eating healthy, even organic, doesn't really cost more. And then he shared a couple of articles that talk about it that I will put into Six Shot Saturday for us.
Yeah, definitely put those into Six Shot Saturday. And I like having this comment, one, because David is super smart. He's a doctor. He knows what he's talking about. And investing in your health from an eating perspective doesn't really have to be more expensive. But Nicole, when you and I were discussing it, and you have a small family or a family with small kids, it's not necessarily hitting the easy button. Right. So
that's true, especially for me here. It was a lot easier when I lived in Austin.
Rather than,
I used to have produce delivered from the farmer's market to my door once a week, and they don't have anything like that in Keller.
Yeah. So there's some issues like that. But I think these two articles, which we'll put in Six Shot Saturday, may help some of us on that journey. Can we go get happy now? My head hurts from being so geeky.
All right, let's do it.
Hey, welcome to the Happy Lab, where we noodle on what, Nicole?
How to live a happier life.
All right. So every year for the last 4 years or so, I have picked a word to be my guiding light for the year. And I found my word for 2018. And I've really found this to be very helpful because it's nice to find something that solidifies everything for you in terms of helping you make decisions through the year. So, Nicole, do you know what my word is?
I don't. What is your word?
You actually influenced this word, and I was excited. I celebrated when I found this word because the word for 2018 for Mr. Roger Whitney is celebrate.
Excellent. What will you be planning to celebrate?
Well, that's good. So glad you asked, Nicole. I tend to not celebrate things. My birthday's coming up, January 22nd. I'm going to celebrate that. My son's birthday, we do birthday parties and things, but we don't make as big a deal out of things like that. My wife's birthday, our anniversary, 200th episode. We're going to find things to celebrate, and I'm going to make sure that I go a lot bigger than I normally do because sometimes I just sort of downplay them, and I think I need to celebrate things more.
I think that's a good plan for the year.
So if you want to be happier in 2018, why don't you come up with your word? What is going to be your guiding light this year? And I can't wait to hear yours, Nicole.
I'll let you know. So one of the things that I am going to really encourage Roger to celebrate in 2018 is the release of his book, Rock Retirement. It's coming out in March. And if you would like to get a pre-release copy from Roger, signed by Roger, just leave a review on Amazon or Barnes & Noble. Can we do that? I don't know.
Yeah. And the book's free. The book's free with shipping if you leave a review.
Yes. So if you leave a review, let us know and send us a note with your address and we'll send you a copy.
And the review can be totally honest.
It should be totally honest.
Definitely.
Don't go easy on him, guys.
Wait. Wouldn't be love. Truth with love. Truth with love. All right. We're looking forward to spending 2018 with you guys, creating not just a great retirement, but a great life.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.